After 6 quarters in recession, the sleepy euro area is finally stirring back to life with 0.3% growth in the second quarter. Manufacturing surveys add to the optimism. The Eurozone PMI rose to its highest in more than 2 years, and growth appears to be broadening to the peripheral economies. 3 of the region's most troubled economies, Greece, Spain and Portugal, saw strong export growth during the first 5 months of the year.
I think the upturn is fairly lasting. It was caused initially by the big fiscal squeeze as they were raising taxes and cutting spending. It looks like that's past the worst. And it was also caused by the banking sector deleveraging, and the banking sector is looking healthier. So those 2 big headwinds are fading, and as a result, the European economy's return to growth. It's probably not a V-shaped recovery, but you can see right across the board, things are really going from bad to a little bit of growth.
But it may take some time before Europe experiences a full-fledged recovery.
The PMI is mildly positive, so there is a bit of recovery going on in manufacturing, but other indicators are still down. When I say other indicators, I mean investment, unemployment, retail sales. So we are still some ways away from being in a place where we can say there is a strong, sustained recovery in the European Union.
Still, the fact that the economy has picked up a bit is welcome news for European equities. HSBC says there are 3 ways investors can play Europe's recovery story.
First, we like small and mid-cap companies in Europe because these companies cater to niche markets within Europe and they're the most sensitive to any pickup in continental demand in Europe. The second theme we like are European global names, that they are big brand names that we think that their valuations are reasonable and they'll continue to consolidate their market position in the coming months. And the third theme we like are European cyclicals because these companies are very sensitive to any pickup in industrial production, which we are starting to see a big revival there, and we think European cyclicals will do well in the coming months. Within European cyclicals, the sectors are European industrials, European banks, and of course European energy companies.
Asia is also hoping for a steady recovery in the Eurozone. Asian economies have been fairly resilient to the global economic slowdown over the past 3 or 4 years, but there are now concerns that growth is running out of steam. Large current account deficits in countries like India and Indonesia have sent investors scurrying. Any pickup in trade with Europe will thus come at an opportune time.
Europe has been out of the global market over the last 1.5 years. They were in recession. So when they pick up and enter back into the global economy, providing the demand, it will restore that current account deficit in many of the Asian countries because Asia will have a new destination to sell their exports to. And that's definitely positive for Asia in the longer term.
The other angle is slightly less obvious, but there has been this risk of if you like, a Lehman-type event in Europe because of the weakness of the financial system. And as the economies improve and the financial system strengthens, the risk of that, if like global shock from the financial system, which would affect Asia as it would affect everybody else, is diminishing.
HSBC says Asian infrastructure companies with exposure to Europe, Asian consumer companies selling to Europe, and Asian transportation and airline stocks will do well in this environment. But Asian banks may face more competition as European banks return to the region.
That over the past 2 or 3 years, European lending into Asia has been falling, and European banks in many cases have been selling their businesses in Asia and withdrawing from the region. So this has created business opportunities for Asian banks, lending opportunities and opportunities to buy assets at relatively discount prices. Of course, it does suggest that if the European banking system is healthier, then maybe they're going to become a bit more stable in the region and it's going to become a bit more competitive for the Asian bank.
Meanwhile, the recession and structural reforms in Europe have resulted in an improvement in the business climate. Wages in the peripheral countries of the Eurozone have fallen sharply. At the same time, productivity has accelerated.
Wages in many of these peripheral economies had gone up since the creation of the euro. They'd lost competitiveness against Germany. And what you've seen over the past 2 or 3 years is a lot of reform, especially labour market reform in these countries, has lowered wages and it's improved competitiveness.
Still, it may be too early for Asian firms to jump into the European market now. Leon Perera from Spire Research says companies should study the market before going in. He sees opportunities in the high-tech area.
Asian companies can leverage Europe's strength in innovation In areas such as medical technology, for example, that is a very interesting area where Europe has great strengths, and there are also very interesting high-tech startups in this area coming out of their science parks and their incubators, which could be M&A targets for Asian companies. Medical technology is definitely one area that we're bullish on, where Europe can be of benefit by R&D partnerships and M&A for Asian companies. And in the same vein, I think 3D printing and nanotechnology and other similar high-tech areas could be very fruitful areas to explore.
Asian companies can also explore the option of locating their manufacturing operations in the euro area.
Poland or perhaps some of the other Central European countries like the Czech Republic or Hungary are very attractive destinations for manufacturing for the reason that they have a lower cost structure, they have all the benefits of EU market access, and logistically they are also within easy striking reach of other big and growing economies like Russia, Turkey and the MENA region, Middle East and North Africa. So it certainly warrants a look, but it has to be looked at cautiously.
But they will have to manage their supply chain carefully. They need to look at how they can outsource lower value activities to the lower cost countries and the higher value activities to the high cost countries.
Companies need to plan their strategy very thoughtfully and carefully, maybe locating different activities in the entire supply chain in different countries, production in Poland or Central Europe, logistics in the Benelux countries, R&D partnerships, and product development perhaps in Germany or the UK or France.
Another sector attractive for Asian investment is the smartphone space.
One interesting area I think is smartphones, both the hardware as well as the applications. This is a field where some of the leading countries in Asia are ahead of the curve compared to Europe in terms of quality, in terms of penetration, and that could be an area where Asian companies have the opportunity to sell products and solutions into Europe.
As the European economy chugs back to growth, concerns remain that the debt crisis could flare up and throw the region back into turmoil. Greece's debt numbers are looking terrible despite the restructuring last year. Germany is going for elections later this month. And external events like a bigger than expected scale back of US monetary policy could cause European yields to surge and stifle the nascent recovery.